I had an agenda for tonight, and an event happened about a week and a couple of days ago, which has made me wonder whether actually there may be more benefit in talking about the impact of Brexit on our portfolios and how we as investors should be looking to the future. I started off as an ISA investor in 1993 in my 30s, and at that point I was newly qualified, newly qualified chartered accountant, house with a mortgage, young children, all the rest of it, not able to put a huge amount of money into the ISA. But since 1993, I have sort of invested fairly continuously, even if not maximising my annual allowance. And as of the end of last year, which happened to be the high point, that ISA had grown at 17.6% per annum and had reached a figure of about 1.7 million. And I should say that's the combined figure for my wife's ISA and for mine. I think I've just become an ISA millionaire in my own right for about 5 minutes on December the 28th. Now, I was going to cheekily ask whether anyone had voted leave here, because it's had quite an impact on my portfolio, and I wanted to know who I could pass the bill for tonight's meal to. But I decided, no, I wouldn't cause unnecessary and uncomfortable debate. So ISAs, as you know, were set up in 1987. As recently as 2015, 80 billion was invested into 13 million ISAs. There's about 23 million ISAs. Some of those aren't as active as they might be, but that's a big chunk of cash that was going in. Now, when I wrote the ebook, I was lamenting the fact that so little of that 80 billion found its way into stocks and shares. In fact, only 23% of that figure found its way into either institutional investment funds or directly into individually held shares. Most people put into cash ISAs. And if you look at the average value of an ISA, those holding only cash ISAs, and the figures are a couple of years old, had just 8,600 in their ISAs, whereas those who combined both ISAs, cash and stocks and shares ISAs, had a figure of just close to 50,000 in that. And really, the people who put their money into cash should really ignore the importance of compounding. They were earning small amounts of interest, albeit tax-free within their ISA, but they were missing the compounding benefits of investing in the stock market. And as of the end of last year, over that 23-year period, the FTSE All-Share had compounded at 7.6%. So you were still going to do very well if you'd been able to put the maximum in and benefited from that kind of tax-free return over that very long period. Now, until the end of last year, I'd been successful in beating the FTSE All-Share with dividends reinvested 17 out of 23 times. It's not going to happen this year. And it's not going to happen this year by quite a big way. What are the key lessons? Well, I have 10. 2 of them relate to young people, and there's only 1 or 2 people here. The rest of us have missed those lessons, I'm afraid. We've got to rely on the other 8. The first one I've touched on, compounding tax-free returns. The second one is not assuming that smart money or big money is necessarily smarter. There's a lot of reasons why the best fund managers can't get the best returns. They're often pursuing their careers. When they make a big bet on something and they get it wrong, there's career risk associated with that. But really, particularly in the small cap world, to have a big fund, the only way you can make it work financially is to have the biggest fund that you can. And if you're going to have a big fund, you're going to have a lot of stocks in that. So a typical small cap fund manager might have 200 shares in their portfolios. It's impossible for them to track that really well. And if as a private investor you're able to focus on a narrower range of stocks, get to know them really well, come along to events like this, you're probably going to know a lot more about that, and you're going to avoid such bad situations. I mean, I know really bright, well-known fund managers who are backing Globo almost right to the very end. And yet wise private investors, or at least some wise private investors, were able to sidestep Globo. which, for those of you who don't know, was a fraud, a Greek fraud that came to light last year, but had been suspected of being a fraud for a number of years prior to that. And so, yeah, if you're a private investor and you can give it the time, you can do better than having your money invested elsewhere. If you're not interested in investing, well, you're probably not going to be here anyway, and you've got other interests, fine, put your money with a fund manager. They'll do a very good job for you. And also, I think it's fair to say, if you're not sure about a sector, I don't know, biotech or gold, then there is real benefits in investing with a professional. So I'm not saying you only have to go down the doing it your own DIY approach. You can mix and match, and it's always useful as well to have something to compare your own performance against, and that's something I've always done, taking fund managers that I respect and looked at how they've done each year or each quarter compared to my own performance. As you know, I don't like story stocks. I don't like hearing the word hope and belief. We heard a lot of that in the lead up to the vote a few days ago, and generally story stocks end in disappointment. There's more wealth that's destroyed, more private investor wealth that's destroyed that way than in any other class of investment. And if I went through all of my investments since 1993, and I found that almost none of my story stocks worked for me. The only real success was autonomy. It was a 10-bagger. It paid for many, many failures. But nonetheless, when I look at the total returns I achieved by buying highly valued story stocks, generally I did much better buying quality stocks that had more resilient earnings and where you could look into the future and make some sensible predictions about where the businesses were going. I mean, as an accountant, it's easy for me to say this, but I always start with the numbers before I listen to the story. There's some really very effective salespeople who are leading up some of our companies, and in AIM, you'll find some of the best salespeople, and you've got to be very wary. And the danger is, if you're not too comfortable with numbers, then you're going to naturally be susceptible to stories. And then you've got to rely on your ability to better read individuals, read character, and not everyone has got that, and even if you have got it, you can't always be consistently good. So, I've always focused on the numbers first. If I'm happy with the numbers, then I'll start going into the story. And generally, stories are much more complex to understand as well. Certainly I find stories very complex. They need a lot of work to actually understand the business and all the pros and cons. And if, often I find the numbers aren't speaking to the story, then I'll simply stop listening to the story. And I find that the example I always quote is a company called Silverdale. Some of you, an asbestos remover, who was saying they were a world-class business, market leaders, generating a 1% profit margin. There are no 1% world-leading businesses. They don't exist. They've all got competition, and they've all got technologies which are under threat. So my focus is always on businesses that generate high profit margins, high returns on capital and equity. Cutting losses, really important. I know it's said repeatedly. I say it to myself repeatedly. I don't always listen, sadly. But cutting losses and running profits is absolutely key to being a successful investor. In fact, you could almost run a portfolio made up of losers if you were really disciplined in cutting those losers and just running the profits on the ones that you did manage to pick out. You'll still find that you've done very well. I mean, over 23 years, only around 60% of the investments I made were successful. I mean, that's I think, quite poor hit rate. But the part of the reason why I did well was that I was able to cut my losses, and I have an inbuilt bias towards wanting to run profits. But when I say run profits, you've got to be close to the market. You've got to listen to the stories that you're hearing from the companies. And if that story changes, if events change, then you've got to be flexible. You can't just say, I bought Marks and Spencer's in 1985, it was a great company. Well, today it's not such a great company, and the decline in the pound has made it even less so. And remember also that if you take a 20% loss on a share and you reinvest the money you've got left, you've only got to make 25% on the next one to be back to zero. But if you take 90% hit on a share, you're looking for a 10-bagger. Now, I've only had a handful of 10-baggers in 23 years of investing. They don't come around very often. So really try and avoid those big losses on shares. Really take the hit. And always remember that you're not a penny worse off when you sell that loss-making share. Not a penny worse off, but psychologically, you are much better off. Your whole mental state is better. There's nothing worse than seeing red on your screens and seeing it there for a protracted period of time. Focus on quality I've touched on. Liquidity and knowledge was another theme I touched on. I mean, that's really come through in the last few days. I mean, we've seen the FTSE 100 soar, we've seen small caps and FTSE 250 dive. Anyone here investing in small caps will know how difficult it is to get out of them. So then you're relying on your knowledge. Knowledge then can give you the confidence to stay in a position that's gone into loss or that's losing. But also, if you're investing in the right type of companies that have strong cash flow, strong balance sheets, you can afford to wait until valuations come back. If you're investing in more cyclical businesses, you really are exposed at times like this. So, I mean, that's as much as I want to sell on the ISA for now. I mean, obviously delighted to take questions in a bit. I just wanted to touch on the vote and how it might impact investors. And I have to say, I did economics as a degree, but I'm no economics expert, and my knowledge and my views here are probably no better than yours, so I'm more than welcome to listen to your views during the Q&A. We've all probably got a different interpretation. But I suppose if I'd had the ability to buy a company called Project Fear a week before the vote, I would have definitely gone long Project Fear, because we've seen in the subsequent events, well, I'll just list them for you. We've seen the pound go down to $1.30, having peaked at $1.50. We've seen the FTSE 250 slump by 15% at its peak. It then recovered to -6, and I think it's now down to about -9%. We've seen gold shoot up $85 to $13.50. We've seen the plans to end the deficit by 2020 scrapped. We've seen the total debt is going to rise and continue to rise. Interest rates have been flagged to be reduced further. The Prime Minister and the chief Brexiteers, Boros and Farage, as the people in the European Parliament insist on calling him, have left their jobs. Corbyn, the self-styled leader of the Parliamentary Labour Party, he's fighting to hold his post. We've seen Scotland, Ireland, Gibraltar, I mean, even the other unintended consequence, we've suddenly seen Austria announce that they're going to rerun their presidential election, where the far-right candidate only lost by 30,000 votes, and he's going to take great comfort from the vote in the UK. But anyway, let's look at the impact on the market. I mean, I think we can argue about the impact medium and long term on the British economy, but I think it's very hard to argue that we won't be facing a recession in the short run. This has been a shock to the system. Anecdotally, in my world of corporate finance, I've already seen 2 deals that have been pulled because of it. And then also I've heard of people pulling out of property deals as well. And I think investment decisions are going to be held back. So I think short term we've got to accept that there's going to be a recession. How long, I don't know. There's political risk. I mean, we see that within the UK. We see the integrity of the UK again potentially being put under strain. But also there's political risks in Europe. And some of the same issues that have affected the vote here are also being seen across the pond in the US, and as investors, we've got to think to ourselves, what would be the impact of a surprise win by Donald Trump come November? Timing is going to be another factor. There's lots of political decisions, and it's impossible to sort of plot all the potential scenarios. But we're in for something that could last between 2 and 5 years, and all of that leads to more uncertainty, which may, as investors, bring opportunity as well. But we've just got to be mindful of it. And also a lot will depend on the flexibility of the UK economy to adapt to these changes and to adapt to the shocks. And if one listens to one school of argument, well, Britain is great and its business will adapt. And if you listen to another, then the view is that we may be great, but we're still going to have to face a lot of issues that are going to impact our businesses. touched on European contagion. I mean, it's worth pointing out the weakness of some of the European economies. I heard yesterday that non-performing debt in Italy represents 20% of its gross domestic product. We are, if there is contagion that spreads through into Europe, whether we are in the EU or not, we will feel the impact of that decision, of problems within our European, within those European countries. And then we've got to also factor in public policy responses. And I have to say I've been quite poor at doing this. We've already seen, as I've said, the Bank of England making a statement and the Chancellor making a statement. But looking forward, we've got to think through what will be the impacts on interest rates. Will there be any helicopter cash? We've had QE as a way of trying to stimulate spending. Will now the government sort of look to just chuck cash at sectors and see if it can get direct to the buyers, to the consumers? And maybe we've seen the end of austerity, but of course that means weaker public finances, certainly in the short term. So looking into the medium term, I think some of the problems we've got have been reflected in the Brexit vote, but actually have been there for some time. One of the really stems back to the issues of 2008, which were never really dealt with. We had excess global capacity in 2008. It had kept interest rates and inflation very low. But that excess capacity, that deflationary headwind, hasn't really ended. We have China, who are new to capitalism. It's a form of state capitalism. Unsophisticated investors. I don't think they've ever read my book on investing and getting returns on capital, because frankly they're willing to invest huge amounts of money for tiny returns, and that's been part of the problem of the overcapacity in the worldwide system. And then we've had the distortions we've seen, and also the distortions that led to low interest rates and low inflation, led to banks and private individuals taking on a lot more debt. And we haven't really seen that massive build-up in debt. And if you look back, it was a 30-year debt cycle, that helped growth run at a much faster rate than it might otherwise have been. We're now having to see that unwind. And so I think that the question is how you play that, and I know people like Gervais Williams would argue you've got to invest in small caps. They're more flexible and adaptable, and they will be better able to cope with a no or slow growth global economy. The other thing we'll have to factor in is populist policies by government. I think that's increasingly likely, and more political shocks. So what I'm trying to do is balance my portfolio to cope with that. I haven't done it particularly successfully, I'll be honest with you. But I have increased my weighting in gold, both principally through ETFs. I do think that gold, if the inflationists win out, then you've potentially got some protection with gold. If we're going to see more political shocks, then again gold works quite well. Now it's a tricky thing, because you can't, most gold companies are difficult to sort of understand and value, and I would say that if you're not an expert in that area, it's best probably investing through a fund. But I know sometimes private investors say, look, we're no good at understanding the global economic forces. We're much better at picking individual companies out. And it's a bit like somebody becoming an expert in Deckchairs and really understanding where the best Deckchairs are going to be, and how to find them, and what they look like, and how comfortable they are to sit on. But if you're on the Titanic, picking the best deck chair isn't much of a benefit. So I think that even though we all find it difficult, we've got to try and raise our heads up and look at these sort of broader issues, and try and take a view and position our portfolios accordingly. I should say that at the moment I'm negative on things on corporate brokers, plant hire companies, the premium end of the property market, and UK retail. So I'm sorry it's been quite a somber presentation, but I think that hopefully we can cheer each other up over dinner.
All right, thanks very much, Leon. We've got a few minutes for questions. I've got one actually, seeing as I've got the microphone. You were well known for selling all your shares before the 2008 crash, if I remember. You almost, with 2020 hindsight, claimed you had total foresight. And that did your portfolio a world of good, obviously. Did you do the same a couple of weeks ago?
Well, I, to be fair, I did say it was probably the only time I would get that right in a lifetime. So I was worried about things. I wasn't necessarily focusing specifically on Brexit. I was around 22% cash when we were at the time of the vote. So I had a very painful Thursday because I became convinced that the Leaves were going to get it, and but I was too tight to take out insurance. That's the brutal truth of it. So I started taking some insurance out after the event.
You talked about cutting losses. I actually find it harder to run with the winners, and when things go up, double, triple, five baggers. Well, I haven't had many five baggers, I have to say. But can you talk about how you run with the winners and how you keep holding on as they go up? And
Yeah, I suppose. I mean, it is critical. I mean, I remember someone from IG Index, who, the spread betting company, telling me that the majority of people on their site make winning decisions, but 90% of the people on their site lose money, which is, at that point, why I decided to switch from using IG in one way to becoming an investor in IG. And I think that there is that bias that we grab at the quick profit, but we can't face the prospect of letting go something that's losing because we're hoping it's going to come back. And I think we all have that bias within us. I think that's just hardwired. I'm not sure for what purpose we've been hardwired to accept that. No doubt there has to be some good reason why it's helped the human race get to where it's at. But from an investing point of view, it's not good. I mean, all I can say is if you invest in companies that have got really good economic characteristics, then that will often give you the confidence to carry on holding. And I think and generally when good things happen to good companies, and so generally when a company's doing well, other good things will happen. More people will come knocking on their door. Their profile would be that much higher, greater. They'll attract other people. Other companies will want to sell to them. And so generally speaking, I've always been surprised to the upside when companies are doing well. And you could say the converse is true, that when a company issues a profits warning, you can always guarantee there's going to be two or three, another one or two that follow that. So I think that I understand it's difficult. I can't say I get it right all the time, but I think if you just bear in mind what you've got to do to make good your money. And I think when I did my analysis of my own portfolio and I looked at those companies that I'd sold that had subsequently gone up, I think I can't remember the exact numbers, but I remember 5 that I'd sold went bust eventually, and it was a handful of companies and a small handful that subsequently went up and did a lot better. So they may have done better temporarily, and I might have kicked myself for why didn't I keep them. But actually, those companies that I sold because I'd lost confidence generally did worse in the long run. So, it's a tricky one, but that's the key one to master.
You mentioned at the start you compare yourself periodically with fund managers that you admire. Can you give us some examples of who that might be?
Yeah, sure. So I like Anthony Cross, who runs the Lion Trust Fund. He's been at it for over 20 years now. He focuses at companies with lots of with strong market positions, an emphasis on human capital, where they've got skill sets that are difficult to replicate. And he's been remarkably consistent. He's also very disciplined on valuation. He won't buy crazily valued businesses. Mark Slater, you probably know of. I mean, he's actually, since 2009, he's actually done until the end of last year. He actually did better than me, and he's had a few big winners which have accounted for that. But he's again a sensible guy. He's actually, I can say this now about his father, he's actually been able to put into practice a lot of his father's teachings, but he's actually done it in some ways better than his father. Gervais Williams, I respect. he has got the challenge, though, of running a very 200 company portfolio, and that can be a problem. I like Fundsmith, Terry Smith's fund. I think that that he focuses on the 30 or so really big companies worldwide that have a lot of the economic characteristics I like: high returns on capital, high profit margins. He does it on a global basis, and that fund's done really well. And also, I'd look up a fund run by Keith Ashworth Lord. He runs the Buffettology Fund. He's someone who used to write for The Analyst magazine, which was one of the driest investor magazines you could hope to buy. I mean, I tell you, if you suffer from insomnia, that's the one well, that would have been the one to get. But nonetheless, he had an uncanny knack even then of spotting great winners. I remember he really liked Reckitt Benckiser years ago when it was, I don't know, £5 or £6. It's now 70 odd pounds. And he 5 years ago, he decided to set up a fund. He's now about, as I said, over 30 million under management. And the fund's been a real outperformer. And again, it follows through a lot of the methodologies and approaches that I adopt.
Well, thank you very much, Leon, and I'm sure we want to show our appreciation. Thank you.